March delivery season is live. Right now. Not next week, not next month. Right now, today, March 5th, 2026. And here's the number you need to stop and look at before you do anything else today. 10,526 contracts stood for delivery on first notice day. That is 52.63 million ounces of silver, legally demanded, physically requested, against a registered vault that holds approximately 86 million ounces. More than 60% of everything deliverable in those vaults was claimed on day one. I am not going to tell you COMEX is collapsing today. I am not going to tell you the price explodes in the next hour. What I'm going to do is walk you through exactly what those numbers mean, what has already happened in the last 60 days that nobody in mainstream finance is talking about, and what the three most likely outcomes look like for the rest of this month. Because here's the thing, this is not theoretical anymore. The math is live, the deliveries are arriving, and the next 30 days will either confirm or break everything we have been watching build since October 2025. Let's build it from the ground up. Every number I give you today is public and verifiable. Links to all data sources are in the description. Section 1. What the vault actually looks like today. Before we get into March delivery mechanics, you need to understand what the starting inventory picture looks like as of this morning, March 5th, 2026. COMEX registered silver. The metal that is legally designated and available for delivery against futures contracts, approximately 86 million ounces. Now let me give you the trajectory so you can see what has been happening. April 2020, 240 million ounces registered. October 2025, 167 million ounces. December 2025, 130 million ounces. February 5th, 2026, 103 million ounces. February 11th, 2026, first time in the modern data series the number fell below 100 million ounces. Today, March 5th, 2026, approximately 86 million ounces. That is a 64% collapse in registered silver from the 2020 peak. Not a blip, not a one-week event. A persistent accelerating drain that continued even as the paper price fell 29% from its January all-time high of 121.62. Now here is the critical number most people miss. Total COMEX silver, registered plus eligible, sits at roughly 440 million ounces. But only 86 million of that is registered. Less than 20% of the reported silver in those vaults can actually be delivered. The other 80% belongs to owners who have chosen not to make it available. You cannot force eligible silver into the registered pool. The owners decide. And right now, with silver down from January highs, those eligible holders are not converting. They are waiting for a higher price. So the deliverable pool today is 86 million ounces. That is the physical reality when March delivery demand arrived at the door. Section 2. What already happened in January and February. The numbers the market ignored. Before we talk about March, you need to understand what January and February just told us, because these 2 months are the most important data points we have for understanding what March might look like. January 2026 is not a major delivery month. Historically, January delivers between 1 and 5 million ounces total. That is the baseline. January 2026 delivered 49.4 million ounces. That is 7 to 10 times the historical norm for a minor month. In just 7 days in early January, 33.45 million ounces were physically withdrawn for delivery. That is 26% of the entire registered inventory disappearing in 1 week. Then February happened. February is also a minor delivery month. Historical February deliveries run between 3 and 5 million ounces total. February 2026 delivered 25.18 million ounces, 5 to 8 times the historical normal for that month. The highest February delivery volume in the modern history of the exchange. And here's the institutional data point that should make you sit up. On February 24th, 3 days before March 1st notice day, 229 delivery notices were issued in a single day. Wells Fargo issued 228 of those notices. BNP Paribas stopped 155 on the other side. This is not a Reddit squeeze. This is not retail. This is Wells Fargo, a major financial institution, demanding physical silver at bank-level volume in the final days of a minor delivery month. When Wells Fargo is moving like that in February, you pay very close attention to what March looks like. Now here is the number that ties it all together. In the last 60 days alone, COMEX has delivered 74.38 million ounces of silver against a vault that currently holds 86 million ounces. That means 86% of today's entire registered inventory was delivered out of this vault in just the last 2 months. That is the highest 2-month delivery rate in exchange history. Section 3. The March math that does not work cleanly. Let me show you the numbers plainly. No framing, just arithmetic. March 1st notice day standing delivery demand. 10,226 contracts, 52.63 million ounces. Registered silver available, approximately 86 million ounces. That means 61% of all deliverable silver was demanded on day one of the delivery window. Now let us apply historical delivery rates to understand where this goes. Normal major month delivery rate, 10 to 20% of open interest, stands for physical. But January and February 2026 were not normal. They ran at 7 to 10 times historical norms, and March is COMEX's biggest silver delivery month of the year. Historically, March sees more participation than either January or February. If March continues at even 50% of the January-February pace, you are looking at 40 to 60 million ounces standing for delivery through the end of the month, against 86 million ounces in the vault. That is not impossible to manage, but it is tight. Very tight. If March approaches the delivery behavior we actually saw in January and February, the vault buffer approaches zero before the month ends. And here's the variable nobody can fully answer yet. How many of those 10,526 contracts that stood on day one are industrial users who want physical metal and will not roll forward under any circumstances? That number starts revealing itself in the CME daily delivery reports. The first one drops today after 3 p.m. Eastern. That is your first real data point. Section 4. The bear case. Because honest analysis requires it, I always give you both sides, so here's the strongest version of the argument against March delivery stress becoming a crisis. March is a major futures month. Major months historically have lower delivery percentages relative to open interest than minor months. The reason is participation. March participants include hedge funds, commodity trading advisors, and speculators who use futures for price exposure, not for physical metal. They roll. They have always rolled. Projecting January and February's extreme delivery behavior onto March may be the wrong model. Additionally, when delivery occurs on COMEX, physical silver does not typically move. A delivery is a transfer of a warehouse receipt, a change of ownership on a warrant. The silver stays in the vault unless the new owner decides to withdraw it. So surging delivery numbers do not automatically mean silver is vanishing. Gold Silver published a detailed analysis this month making exactly this point. Their conclusion was that COMEX default is not the right framework. The real question is whether orderly repricing happens, and long-term silver investors benefit more from orderly repricing than from market chaos. That is a reasonable position. I am not dismissing it. But here's what I will say. That bear case assumes March behavior reverts to historical norms. The entire story of this silver cycle since October 2025 is that nothing has behaved according to historical norms. The vault is down 64% from its 2020 peak. Minor months are delivering at 7 to 10 times normal. Wells Fargo is pulling physical metal at bank-level volumes in February. The bear case requires you to believe March suddenly normalizes after 5 straight months of abnormal behavior. That is possible, but it requires evidence, and the first evidence arrives in today's delivery report. Section 5. The 3 scenarios for the rest of March. Here are the 3 most likely outcomes in order of probability based on what the data is showing right now. Scenario 1. The managed roll. Most likely, banks and exchange participants execute what analysts are calling a shadow bailout. JP Morgan and other major dealers use exchange for physical arrangements, EFP, to pay significant cash premiums to large long holders. Those holders get paid to move their delivery demand from New York to London or to a later contract month. SLV, the silver ETF, holds approximately 91 million ounces in its New York vault. There are reports this eligible pool could supplement registered delivery supply if needed. Under this scenario, March delivery stress is real but contained. The vault holds, the paper price stays volatile. The structural problem is not resolved. It is deferred to May and July, which face the same math at smaller scale. Why is this most likely? Because COMEX has managed delivery stress before. Because the exchange has multiple tools, margin hikes, rule adjustments, EFP cash outs. And because large institutional holders often prefer a cash premium over the operational complexity of taking physical bars. Scenario 2. Partial break. Possible. Delivery demand exceeds what the managed roll can absorb. Registered silver drops below 60 million ounces before month end. The exchange raises margins again, as they did multiple times in February, including once at 11 p.m. on a Sunday night. Price swings become violent, potentially $10 to $15 intraday moves. Shanghai Premium widens further above its current $8 to $13 level as physical demand accelerates outside Western paper channels. Under this scenario, COMEX does not formally default, but the mechanics become visibly strained in real time. Cash settlement on individual contracts becomes more common. Silver discovers a new higher price range, potentially $95 to $110, as the market prices in ongoing structural stress. Scenario 3. Formal delivery failure on individual contracts. Less likely, but not impossible. Registered silver is exhausted before all standing delivery demands are satisfied. Individual contracts cannot be fulfilled with physical metal. Cash settlement is imposed rather than physical delivery. This is not a COMEX system collapse. the exchange itself would not fold, but individual contract holders who expected metal get cash instead. The credibility of the paper pricing mechanism takes measurable damage. This scenario is less likely because the exchange has many tools before it reaches this point, but it is not impossible. The Hunt Brothers episode in 1980 ended with the exchange unilaterally switching to liquidation mode. No new long positions permitted. That is an extreme measure. It has happened before. Section 6. Samsung, Tesla, and the companies that already stopped trusting the exchange. There is one more piece of this picture that the delivery reports will not show you directly. Major industrial users are not waiting to find out which of those three scenarios plays out. Samsung finalized a mining prepayment deal giving them exclusive rights to 100% of Canada's Silverstorm mining output for 2 years. Not a COMEX purchase, not a spot market transaction, a direct lockup of mine output before it ever reaches an exchange. Tesla, along with other major electronics manufacturers, is reported to be negotiating direct offtake agreements with primary silver producers to ensure production lines do not depend on exchange delivery. What does that tell you? It tells you that the largest industrial consumers of silver on the planet have already decided they cannot rely on just-in-time delivery from COMEX warehouses. They are bypassing the exchange entirely. That metal never enters the registered pool. That reduces the deliverable supply available to everyone else, which tightens the math even further for the contracts that are already standing for delivery this month. Section 7. What to watch today and through the rest of March. All of this data is public and free. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. Here is your watch list for the next 30 days. CME Daily Delivery Reports. Published each afternoon by CME Group. Shows delivery notices issued and stopped by bank and institution. Today's report, published after 3 p.m. Eastern, is the first real data point of the March delivery window. The number of contracts that stood on day one and whether that pace accelerates or slows is the single most important data point you can track this month. Link in the description. COMEX registered silver inventory. Updated daily on the CME website. Watch whether registered silver stays above 80 million ounces through the first week of March or continues draining. A drop below 70 million in the first 10 trading days of March would signal significant physical stress. Silver spot price around key levels. Current silver around $82 to $84. Watch $91 as near-term resistance. If that breaks on sustained volume, the next target is $100. $78 is the structural floor to watch on the downside. Intraday moves larger than $5 signal institutional positioning changes. Shanghai Premium, currently running $8 to $13 above Western Spot. If that premium widens past $20 while COMEX is processing March deliveries, Asia is telling you the physical market is repricing faster than New York paper admits. Margin announcements from CME. In February, CME raised silver margins multiple times, including a Sunday night hike. A margin hike during March delivery would be a direct signal that the exchange is seeing stress and deploying tools to manage it. CME posts these publicly. EFP premium data. Exchange for physical is the mechanism through which COMEX moves delivery demand from New York to London. When EFP premiums spike, New York is paying to relocate physical demand. Elevated EFP premiums would confirm the managed roll scenario is actively happening. Section 8. The honest conclusion. Here is the full picture as of this morning, March 5th, 2026. Silver trading around $82 to $84. March delivery window is live. 10,126 contracts stood for delivery on first notice day. That is 52.63 million ounces demanded against 86 million ounces in the registered vault. 61% of all deliverable silver was claimed on day one. COMEX registered inventory is down 64% from its 2020 peak of 240 million ounces. In the last 60 days alone, 74.38 million ounces were delivered, 86% of the current registered vault in 2 months. January 2026 delivered 49.4 million ounces in a minor month, 7 to 10 times historical normal. February 2026 delivered 25.18 million ounces, highest February delivery volume in exchange history. Wells Fargo issued 228 delivery notices in the final 3 days alone. Shanghai Premium running $8 to $13 above Western Spot. China's export controls blocking clean arbitrage since January 1st, 2026. Samsung and Tesla bypassing the exchange entirely with direct mine offtake agreements. 3 scenarios. Managed roll, most likely. Partial break, possible. Formal delivery failure on individual contracts, less likely but not impossible. The math does not add up in a clean, comfortable way. 52 million ounces demanded on day one does not sit comfortably against 86 million ounces registered when you already delivered 74 million ounces out of this same vault in the last 60 days. What happens in the gap between what is demanded and what is available? Whether it closes through rolls, cash premiums, eligible reclassification, or actual delivery stress. That is what the data over the next 30 days will tell us. I am not here to sell you the most dramatic outcome. I am here to tell you that something structural is happening in this market that the daily price chart is not showing you. The vault trajectory, the delivery numbers, the bank level behavior in January and February, the Samsung and Tesla moves, they are all pointing in the same direction. Today's delivery report at 3 p.m. Eastern is the first live data point of the March test. Pull it, check the registered inventory tomorrow morning, watch the margin announcements. The data will tell the story. Most people will not look because looking requires acknowledging that the system might be under real stress behind the price you see on your screen. The minority who look do not need convincing. They simply adjust. Invest with logic, not hype. Protect your capital. Respect the plumbing as much as you respect the chart. Drop OG in the comments if you pulled the CME delivery report today.